This is Paul doing a quick video. Wanted to update you on kind of some portfolio moves I made, different deposits that I've done, and just quick thoughts on what I think is going on in the market, and then also a quick review of Etrade's fully paid lending program. Um, they don't really have a like an explanation of how the program works. There's no videos, there's nothing, and nobody's bothered to make a video, so I figured I'd make one. Um, so first things first, how's the portfolio doing today? Not so well. Well, a little bit better than the market. Pretty much tracking the Dow right about now. I don't have heavy exposure to the Nasdaq as I've explained in previous videos. I believe it's just overvalued at the moment. Um, Kind of funny. By the time we do the stimulus thing, might end up actually jumping back into the Nasdaq because it might actually correct enough by then. If you have heavy exposure to the Nasdaq, pity your portfolio. Unless you bought last year and then you really don't care because you're still up like 40% probably. So what's causing all the stuff that's going on right now? Um, the simple and straightforward answer: the market is pricing in inflation. Um, so this right here, the 2 year, is what the Fed controls. So the rate right now is between 0 and 0.25, I believe. So you're going to see this float between those ranges because that's what the Federal Reserve controls. Um, Everybody else is expected to play up here. These are all our little playgrounds. So right now you have the Japanese selling off bonds, which is they own a lot of our bonds. So they're selling off bonds because they're having their own issues. Um, and then also you have basically the Federal Reserve telling the bond market that if we see inflation, we're going to let it go for a little bit. It's got to be healthy inflation, can't be like crazy inflation like the 70s. So how would the Fed intervene? There's two ways. Actually, there's multiple ways. I'm sure they'll just magically make up something. But basically, what they do is they have ways of. So the first thing that they could do is what they did in World War II. They could do something called Operation Twist, or not Operation Twist. So basically, they have yield curve control. They literally just come out and say, by federal government, here's what the rate is going to be today. The Japanese have done this, and it's horrible. Um, it doesn't. It's not free floating. It's all over the place. I think the Chinese do this too. No, I think the Chinese actually started. I don't. It's weird what they do, but I know the Japanese control their rates. It's horrible. Um, yeah, it's pretty bad. There's also Operation Twist. You're probably going to hear this a lot. Operation Twist is what the market wants them to do right now. It's literally when they I forgot what they do. I think they basically what they do is they sell what they own on the short end because they're literally buying bonds on the short end, which is the 2 year, and then they use those funds to buy on the long end. So they did this in I think I want to say 2011 was the last time that they did this because we weren't recovering from the last financial crisis quick enough. So they started doing these little things. It's called Operation Twist. You can just look it up. It's it's weird what it is. Yeah, it's kind of weird what they do. Anyways, so the fact that the Federal Reserve has indicated that they're not going to do that yet at their March 17th meeting, and I'm sure they're going to talk about it, like how high the rates are going and how quick, because the 7 basis point move is actually kind of really abnormal. Normally, your moves are like this, or like these little things you see right here, point 0.2, 0.02. These are pretty decent moves. So a 7 basis point move on the 10 year was enough to knock out over 2% on the NASDAQ. The reason why that's going on is basically when these go up, that means borrowing costs go up. I showed this in my last video, how the bond market works. So the bond market tracks the federal market. So the corporate bond market tracks the federal market so that when the federal rate goes up, well, all of a sudden your borrowing costs go up for a corporation. Well, if you're one of these growth stocks that's using a lot of debt to fund your operations, Netflix is a perfect example of that. Tesla is a really good example of that. Um, if you just don't have enough profits to fund your daily operations, you borrow from the market or from the corporate debt market. And U.S. companies are really, really, really big fans of doing that. So I showed that in my last video, just kind of how the corporate debt market looks and what that actually looks like. But normally those rates stay ahead of the federal rates. So if the federal rates start going up, because those are AAA and those are the ones you want to own, then the corporate market has to follow. The problem is this is going to get affected a lot more. Also, if you borrow on margin, that's another thing that gets affected. So you have a lot of people that are really borrowing on margin to fund their operations, their daily trades. That really affects things. So that's what's going on there. How's the portfolio doing? So I got my tax return, took a good bit of it, and threw it into the market. So let's see. Did a few things. There's part of the tax return. Where's the thing at? So I bought 15 of Cisco, 2 of Walmart, 1 of Intel, 6 of Coke, and I did another $100 transfer today. So this $100 right there. And then I bought 2 more of Walgreens in the IRA. In the IRA right here. I did another, where's it at? IRA right there. I did $1,000. Put pretty much all of it into SPHD. If you don't know what SPHD is, it's literally just it's a tracker. It's an ETF that tracks the SPY or the S&P right up here. This guy. And if you can see what stocks are included in there, high dividend stocks, basically that's literally what it is. S&P high dividend, that's kind of what that stands for. Here's that prospectus thing I was talking about last video. If you want to know what's actually in here, every single stock that's in there, they have another, so the number of stocks that they hold is 50. So these are their top 10. That's kind of what you would expect, just basically high dividend stocks. AT&T, obviously, that kind of stuff. It's a pretty decent one to put inside of an ETF, put inside of an IRA. It's got a high dividend yield, pays out. It's one of those ones you don't have to really micromanage. It just turn on the dividend reinvestment and then there you go. So one of the things I wanted to go over in this video was Etrade's fully paid lending program. So what is that? All right. When you go to Etrade, they have this little box right here, what we offer, and it takes you to this little screen. And then you hit apply. Like I said last time, I tried to get into this program for a while just to make some extra money. And I couldn't get in for a while. I don't know what. It basically said I didn't have stocks that people wanted to short. At the time that I applied, I didn't have stocks that people wanted to short either way, so I don't know. So I hit apply online, verify some information in, and they automatically updated my thing over here. And then there's this little goofy video over there that really kind of tells you some things, but it really doesn't. Basically what that video says is that your dividends are traded a little differently if your shares are loaned out, which really isn't that big of a deal. And then that's just for tax purposes, how it appears on your 1099 that you get from the E-Trade or your broker. And then they basically tell you what it is. It's like basically shorts will borrow your shares. Well, what in God's name does that mean? Okay, so the last time that I came here, and when I went over to this screen, and then this screen, there was nothing here. So what's the new thing going on? So the new thing that's going on is you see all these little things. See all these? I actually bought that one share. I sold that one share of GME, by the way, because this was the experiment I was trying to run. So basically what happens is right here, up in here. So right now I have 49 shares of AMC. I got rid of 50 shares because I just wanted to take profit and invest it somewhere else. So I still have 49 shares I'm just going to hang on to. Right there. So these 50 shares are what were originally loaned out, and then these 49 were loaned out. And then if you see, they're still loaned out. So what you're seeing here is what other people are willing to pay to short this stock. So this is AMC. So you see this right here. See how they were doing like a 1.162, and now they're at 1.1868. Then this also shows how much annual income I'm gaining. It's nothing major. Um, it's just something, just some extra income. Some people have told me that they've seen 13% here, or really large numbers. I'm not, we'll have to see if that ever happens. I'll let y'all know. So what does that look like? Okay, what you will see is when I go to my complete view here. All right, so what does it look like on your portfolio? All right, so this is what it looks like. As this little guy right here says fully paid lending, and then also this little guy pops up over here. There's nothing right here right now because I haven't had any deposits from it. They deposit once a month, I think. I'm about to figure that out. But you'll see this, and then you'll also get an email. What you'll also see, so you go under transactions, you'll start seeing this. See this right here? Fully paid lending. And I had to actually go. This is how goofy Etrade is. I had to actually go onto Google to figure out what this actually meant because there's nothing here that actually tells you. So I had to like look up Google, and this actually means fully paid lending, collateral received or collateral returned. So, where's the received? See the received part right here? The received means that somebody's putting up money to borrow your shares. Okay, somebody's putting up money to you to borrow your shares. If that makes sense. And then whenever you sell, so this is the GME share I sold. This is what that guy had. Fully paid lending, collateral returned. So there's nothing that stops me. I sold it. Nobody told me anything. There you go. So I had something like this right here. See the received. So what happens is that pops up. So this is a new one. So this popped up just today. And then tomorrow I will know what that $18 is. Hope that makes sense. So when you go under transactions, and there's actually reports, and then right there within, tomorrow when I go in here, I should be able to figure out what that $18 is. I'm not sure what it is right now, or actually, I don't know. Maybe it was AMC or something. I'm not too sure, but we're gonna have to figure that out together. I'll update you guys next week. There's also a shortcut right here. Once this is actually updated correctly, you can click right there, and it takes you straight to that screen. So that's their fully paid lending program. So that's just a quick rundown of how that works. I didn't have much going on. Just kind of, this is where I'm at on yearly dividends. I updated my sheet so that it shows my IRA dividends, and then it also shows my yearly dividends. Like I said, I'm going to focus on adding money. So like say if I get the stimulus or whatever, whenever they decide to pass that, I might put say another $1,000 towards the IRA dividend or the IRA one. Might pay down some debt or something like that, and then put some more back in the savings. You never know. We'll just have to see how whenever they decide to pay it out, where I decide to put it. I might end up splitting it again, put 1,000 into here, put 1,000 over here, and then something like that. See where it goes. I'll have to see where I want to invest it at the time, and then just kind of keeping all my holdings the same. If I go to my transactions, you will see bought, and the only thing I sold since the last time I was on here was AMC. And then also, by the way, here's all the dividends that paid out from. These are all the municipal bonds that I have. I did have one that was kind of funny. I did add two of them. So I had Intel and I had Energy, but I sold out of them. But I guess I sold out of them after the ex-dividend date. So when they paid dividends, I actually got Energy and I got Intel. I actually bought another share just because I had the money. Bought one more share. So they actually paid me like 0.04, like that right there. I'll decide if I want to add to these positions. I might. I'm kind of lacking on utility companies right now. But having utilities right now where rates rising kind of sucks. If you notice, NEE, I'm getting hammered right now. NEE. So what's going on with utilities right now? They're kind of they basically rely on the debt markets a lot to finance their stuff. This is how they do improvements. Um, it's I have to look into utilities, but basically they rely really heavily on the bond market, like the way that the bond market is structured. So when you see these going up like this, it's gonna hammer utilities. And if you can see, I'm getting hammered, just destroyed on utilities right now. Um, I think outside of AMC, AMC is not killing me as much as like it's 19%, but it's only $93. It's on 16%. I'm down there, and then VTRS is down just because they were very. I guess the best way to put it is they were very cautious on their guidance, so they're getting hammered right now. But once they actually start paying a dividend and then start getting a little bit more, they they only gave like their first earnings report like a month ago, so this one I'm just gonna hold because I already know they're paying a dividend. It's really nice. I think this updated. No, this hasn't even updated yet. See, it still says dividend yield 0, but I know very well. I think their dividend yield right now is like 1 point something percent. So this is gonna go. This I'm just holding because it's a generic pharmacy company. I've always wanted one of those. Um, but yeah, right now I'm getting hammered on NEE. Um, but yeah, that's literally what's going on. Is basically bond rates go up, utilities get hammered. Um, what's kind of funny is that banks actually. Here's the banks right here. Banks doing great. They're down today, but that's because everything was selling off. It was just basically fire sale for everything. Um, so it's kind of weird that energy's up. Not sure. Normally when rates are up like that, something like energy would get hit a lot, but not too sure. Got to figure that out. So yeah, just gotta just invest in a little. If I add any more, I'll post it on Twitter, of course. And yeah. So basically, as far as I can figure, until the bond market stabilizes, nothing's. You're gonna just keep seeing this right here. People are gonna have to sell. That's effectively what's going on. Is people are selling. If you get a huge loss like this and you own Tesla, you're selling your regular stocks to pay for these growth, especially if you're trading on margin. To keep from getting a margin call when they force you to sell your stocks, and actually some of these might be for selling, but to cover these positions where you're taking just massive losses, and you got to think this thing was, if you look at some of the percentages on here, I mean, what was that like? Peloton's lost 30% of its value. If you had a lot of money in Peloton, you know, you're having to cover a lot of losses right now. So where would you cover those losses? Basically in your regular stocks. A lot of really smart professionals have a regular stock portfolio and then they have a growth portfolio. Um, so yeah, I guarantee a lot of people are getting margin called right now. This is what you saw earlier was basically forced liquidation where you just saw this wave of selling and then all of a sudden you saw the hedge funds and the guys with all the money on the side come back into the market. So that's why the market went down like so much and then came back up. But until you see the bond market stabilize, it might not happen until after the 17th when the Fed meets. All the Fed has to literally say is we might think about doing Operation Twist, and then all of a sudden you would see these things fall. But you see this ever since I even started talking, this is going up even further. That tells you after hours people are selling. And if you need a good laugh, by the way, after hours, where was it? Oh, GME is after hours down, but it was actually up. So the rest of the market was tanking, but GME was actually holding steady there. I thought that was kind of funny. Um, those little meme stocks will get hit too because a lot of people buy those on margin, which is really, really, really stupid. Don't buy these things on margin. Please don't buy GME and or AMC on margin. That's really, really stupid. If you can even do that, if your broker even lets you do that, it's highly irresponsible. But you see this right here. If you keep seeing this, you're going to keep seeing this. And at some point, this will get to the point that the Federal Reserve says, okay, party's over. We're going in to buy now. And that's when you'll see the market start to rally again, like these, the tech stocks and stuff like that. But as long as you can keep saying, oh, well, money's coming out of here, out of the NASDAQ where it went to last year, and it's going here, as long as you kind of keep saying that kind of stuff, you know, maybe they might just kind of sit on the sidelines, but at some point they're going to get not comfortable with this. So it all depends on the Federal Reserve and bond prices. You keep seeing this, you're going to keep seeing this. It's very, very predictable from one day to the next. So we'll definitely have to see how it goes. So, but like I said, as it goes down, I'm buying pretty much across the board because I know that this is what happened before. Once bond prices stabilize, it goes straight back up. Because then you can they call it repricing the market or repricing the earnings. Um, so because earnings are determined by how much debt you have to pay out as a company. Well, once this stabilizes, you can actually figure that out where it's fair value for some of these companies, and all of this goofiness stops. But that's not stopping anytime soon until the bond market stabilizes, and it might be until after the 17th. We'll have to see what they say. Powell was asked about it a lot today, and some people were saying sounded like he was getting aggravated, getting asked about the bond market so much. But he stuck to his position. He said, we don't see any inflation. Everything looks fine. This is only temporary. He said basically this right here is only temporary. It's way ahead of itself, and it's going to come back down. I have a feeling it's going to come back down. I actually do think it's way ahead of itself. But without the Federal Reserve stopping it or going in there and having a way to kind of put a halt to it, just by talking, because they can talk these rates down just by saying something. Yeah, we'll have to see how it goes, but that's what to watch right now. That's if you want to keep an eye on what's going on in the market. Um, but we could have another day like Monday where it looked like this on Monday. It looked like this on Monday whenever you hit refresh, and then all of a sudden on Monday, or it looked like this last Thursday, and then on Monday when you came in, and then all of a sudden you were sitting there up 1,000. I was up I think 2 or 3% or something like that on Monday. So gonna definitely have to see how it goes. But if you notice what also happened Monday is these were way down. On Monday when you came in, those were down. That's because there was buying on them across the curve. This is called the curve. Um, and it looks just like a curve. If you draw it out on a graph, it's a curve. But we'll definitely have to see how it goes. So just leave any comments and questions or questions in the comments, and then I'll be happy to answer anything y'all got. Thank you.